So good morning class. Welcome to today's class where we are going to discuss labor costing. To take you briefly what we discussed in our previous class which was about material costing. We looked at material control where we looked at various aspects in material control. We looked at stock control where we looked at various issues that are related to stock control. We looked at stock levels where we looked at the minimum level, the maximum level, the order level, the order quantity, and the other issues that are related to stock levels. Then we also looked at economic order quantity, and we looked at how we compute the economic order quantity, how do we compute ordering cost, holding cost, and then we also looked on how do we consider discounts when we are talking about economic order quantity. So we also looked at material issues where we looked at the FIFO, the LIFO, weighted average, simple average, standard price, and the other issues that are used in a material issue. So our last part of the discussion in material costing, we looked at just in time, where I said that in just in time, they are saying that there is no need to keep stock. So as I said, in today's class, we are going to discuss about labor costing. So this is our today's class, which is chapter 3 or topic 3, and we are discussing labor costing. What do we expect from you after you have completed this class? You should be able to explain what makes labor a direct cost. You should identify the various types of labor, describe different remuneration methods, that is the time-based system, piecework rate system, individual and group incentives. More to that, you should be able to explain the labor control methods and why it is important that manager regulates the organization labor usage. And then you should be able to prepare the relevant ledger entries necessary to account for labor cost. The learning resources, we have Ray Garrison, Eric Norin, Peter Brown, the book called Management Accounting. It was published in 2011. Also have Kaplan and Atkinson, Advanced Management Accounting. It's a bit old, but it's still good. On top of this, there is another book of F2, Management Accounting by BPP, which you can use. A brief topics that we are going to discuss under this chapter. We have the labor as a resource. We have labor as a direct cost. We have direct and indirect employees, labor remuneration, labor control. We look at accounting for labor costs. Then we also look at incentives schemes for remunerating labor. Then at the end of this chapter, we have activities which may be in the form of assignment or which may be in the form of quiz, which are available on your learning platform. So when you talk about labor cost, that is what you pay to labor, which is those direct wages of factory workers, other non-factory workers. We also call them wages, or they may be salaries. And the cost of labor in the total production cost depends on organization. Some organizations that are manufacturing, it may be between 15 to 30. But some of the service organization, most especially, for example, in the university, the cost of labor is in almost similar, is more than, is almost like 80% of the total production cost. So, but in the manufacturing organization, the cost of labor ranges between 15% to 30%. So when you're talking about the labor cost, as I've said, it depends on how you remunerate your labor. It can have a basic pay, that is the day rate, can be day rate, can be weekly rate, can be monthly. Then we also have labor related cost. For example, you may be paying holiday pay, you may be paying overtime premium, etc., or transport or accommodations. Those may also be included in your labor cost. So let's look at the methods of remunerating labor, methods you can use to compute labor wages. How do we remunerate labor? You can remunerate labor based on the time rate method, meaning that in this case you are paying your labor per hour. You are going to look at it can be per hour, it can be per day, it can be per month, but that is in time rate method. It is depending on time that an employee has worked. Either has worked a month, then you can pay that one a month, or you can act an hour, you can pay per hour. So that is how you can, that's the time rate. The payment it is based on the time. It can be an hour, it can be a day, it can be a week, it can be a month. So what is the advantage of paying per hour? First, it is very easy to compute. When you are computing hour, you just know if you are looking at day, how many number of days have you paid, have you worked, then what is the rate per day, or how many weeks have you worked, what is the rate per week. Or if it is a month, then it becomes very simple. So this one is very simple to calculate. So it becomes easier for the employees to forecast their income, because they can know that maybe I'm going to work for 30 days, then every day I'm earning this, and then it can be able easier to calculate their income. Another on this method, estimate the need to measure the performance of the worker. You can easily be able to measure the performance of the worker. It's more suitable for such jobs which cannot be divided into smaller units. If you cannot divide the job into smaller units, then it's a sufficient method to use to compute labor cost. The disadvantage with this method that it may discourage efficient workers, because if all receive the same wage, then you may find that some may not be able to work hard, because you say, if I'm working hard, I'm receiving the same wage as those who are lazy, then it may affect the efficient, it may demotivate some employees. Another issue is that this method requires close supervision of employees, because someone is paid per day. Someone may relax, knowing that I'm just relaxing. I reach in the evening, I ask my pay. So it needs a close supervision to these employees to be able to make them work. So another method of remuneration is what we call a piece rate method. Under this, you are paying per unit of a product, or you are paying per article. You can pay per unit of the product produced, or you can pay per the job completed. Say if you do this job, you finish it, I'm going to pay you this. Or if you are producing unit, if you produce each unit you produce, I will be paying you this. So that is the piece rate method. You are producing per unit, or you are paying per unit an employee has produced, or you are paying per given article or per given job that has been produced by the employee. This method is more efficient if you can be able to divide the job into, or the work into, different pieces. If you can divide the work into different pieces, or if you can divide the work into different units, then you can use a piece rate method. So if you look at the advantage of this method, is that it provides an incentive to more efficient workers, because an employee, for example, if you are produced per unit, then you will work hard, or an employee is going to work hard in order to get more, or to produce more units, such that he can be able to increase his pay. Or if you are given a given job, an employee is going to be working hard in order to finish that job, such that he can be able to earn a higher pay. So another one is, it does not require close supervision. Yes, I can say it can be an advantage because it's an employee. An employee is given so is given a certain job that is supposed to do. You may not need much supervision, but still you may need some supervision because of the quality issues. Another one, it provides employers an easy way to determine the labor cost. It is easy also to compute the labor cost if you are paying per unit or per job, because you know that if an employee has produced 10,000 units and each unit you are paying 20, then you are going to get 20 times the number of units an employee has produced, and then you determine his or her pay. The disadvantage of this are that because you are paying per unit, employees want to produce more units. So in the sense of, or in the act of wanting to produce more units, they may end up producing inferior or poor quality products, because they want, what for them they are looking at is to ensure that they produce more units, which can lead in a short time such that they can get more pay. So in the end, they end up producing poor quality goods. Another disadvantage that this method can be applied to those jobs which cannot be applied to the jobs which cannot be easily divided into. If a job cannot be divided into smaller units, then you cannot pay per unit. So it is only applied to jobs that can be divided into smaller units. So another disadvantage is that this method does not ensure stable monthly income of workers. A worker cannot know, because it depends on what he has produced. If he has not produced anything, it means the worker cannot get anything unless there is a minimum pay. But if there is no minimum pay, then the employee will only earn if he has produced. Methods combining time rate and a piece rate. We have high time rate for overtime. In some cases, an employee may be paid a normal rate for normal working hours, but if an employee exceeds a certain hours, then an employee is paid an overtime. For example, in many cases, for example, maybe in public or in some, may find that the normal hours per day is 8, and maybe on Saturday or in weekends, maybe Saturday, they can say on Saturday you work for 5 hours. So meaning, if you are looking at the total hours a week, an employee is going to work maybe 45 hours a week. So if an employee works more than 45 hours a week, it means there is overtime. So the overtime hours will be paid at a given rate. So it depends on the agreement of payment. You may find that maybe the normal hour is paid, or the normal hour is paid the normal rate, then overtime in a day is also paid, weekend is also paid in a different rate. So you look at those ones, the normal hour, the overtime, the weekend rate, and then you compute the labor cost. Let's look at this simple example. During weekdays, for extra time worked, our rate is 50%. And then during the weekdays, for extra time worked, our rate is 50% higher than the normal hour rate. Meaning that if an employee has worked, for example, we said if he is working 8 hours in a day, and an employee has worked maybe 10 hours, the two extra hours an employee has worked will receive a rate which is 50% above the normal rate. And then for Sundays, it is double than the normal rate. If an employee has worked on Sunday, the rate is going to be doubled than the normal rate. So we are continuing with this. So we are assuming Robert, our rate is 1,000. During a particular week, he worked for 60 hours. including 8 hours on Sunday. His wage rate, or his wages for this particular week will be, so remember he has worked for 60, and we said in our previous issue that if he's working 8 hours a week, it means 8 times 5, that is 40. So 8 times 5, you get 40, then plus 5 hours of the Saturday, it means it's getting the normal hourly rate will be 45. The 40, which is 8 times 5, then plus 5 hours of Saturday, it becomes 45. Then on Sunday, they told us he worked for 8 hours. So meaning the balance, the remaining hours here, which is 7, they are overtime in weekdays. So it means that becomes the total of 60. So we said this one is going to be paid at a normal rate or at a normal hour rate. The overtime in the weekdays will be paid at 50% above, and the hours on Sunday will be paid, the rate will be doubled. So if you look at our solution here, so the wages on normal hours, it's going to be the 45 hours times 1,000, which is our normal rate. Then the weekdays, this 1,000 should be increased by the weekly overtime. This 1,000 should be increased by 50%. So meaning that if you increase this one by 50%, it becomes 1,500. So the 7 hours times 1,500, you get this. Then if he works on Sunday, the hours on Sunday, the rate is doubled. So 1,000 times 2, you get 2,000, and then you get this. So the total cost or the total wages will be 71,500. So we also have the piece rate with guaranteed time rate. So we have looked at our rate with guaranteed. So you can have that if you produce maybe 1,000 units, or an employee may be paid maybe 10,000, but if you exceed, you are getting more. But let me say this way: an employee may be paid maybe 20,000. What we are talking about here is that an employee is guaranteed a certain wage rate, like that whether when output is below maybe a given standard, the employee receives that wage rate. But if the output, it produces more than more output than the normal, or than the normal, then the employee is going to be paid according to what is produced. That is what we mean by piece rate with guaranteed time. There is a fixed guarantee that an employee cannot go below. But if the production is more, then an employee is paid more than the guaranteed payment. For example, if you look at this this illustration, assume the guaranteed wage is 15,000 and is paid 50 per unit produced. Find out his monthly wages on the assumption that he produced in this. So these are the assumption: he produced 500 units, and here he produced 270 units. So if an employee has produced 500 units, it means if you look at the payment per unit, it will be 500 times 50, then you get 25,000. So meaning that if you compare 25,000 with the guarantee, the 25,000 is above the guarantee. So in this case, the employee will be paid 25 because it is above what he was guaranteed. But in the second illustration, the employee produced 270 units. So if you get 270 units times what is paid per unit, which is 50, you get 13,500. So in this case, the payment is below the guarantee. So because the payment is below his guarantee, then in this case the employee will be paid what was guaranteed. We also have what we call differential piece rate. So differential piece rate will mean that an employee is paid per given range. That if your production is between this range, you are paid this. If the production exceeds this range, you are paid this. If it exceeds another range, you are paid a given up. So the range increases as the number of units produced increases. So that's what we mean by differential piece rate. So if you look at this example, assume Alex is paid 50 per unit up to 100 units, meaning that if he produces 100 units, he's going to be paid 50 per unit. Then he will be paid 60 per unit if the production is between 100 and 1 to 200. So meaning anything that exceeds 100 unit but does not exceed 200 unit, which is in between that, then the employee is going to be paid 60 per unit. So anything that exceeds 200, the employee is paid 70 per unit. So in this case, that one you go for differential rates. So if you look at that, it means from the first 100 units, because they told us he produced how many? He produced 250. So it means that the first 100 units, the employee is going to be paid 50, which is going to be 100 units times 50, then you get 5,000. But they told us anything that between 100 to 200, meaning another 200 units will be paid at 60. So you get 100 times 60, then you get 6,000. Then anything that exceeds 200, the employee is paid 70. So the 50 units that exceeds 200, the employee is going to be paid at 70. So you get 50 times 70, then you get 3,500. So you get a total wages of 14,500. So let's look at what we mean by premium bonus schemes. When you talk of premium bonus schemes, in this case, an employee beats the target or produces below the target. For example, an employee may be told maybe he's supposed to use 100 hours to produce. But if an employee has produced maybe within 80, it means an employee has saved. There is a saving of 20 hours. So the saving of 20 hours, it is a premium to the company. But what the employers do, that saving of 20 hours is shared between the company and the employees. So that's what we mean by premium bonus. An employee produces below the set standard. For example, you maybe say you are supposed to produce 100 units per hour, and then you find that within that 1 hour, an employee has produced more than, or an employee has produced 100 units but has used 30 minutes. In that case, an employee has saved time in his production. So they are going to be a premium, which is going to be the time that was set and what the employee has taken to produce. That difference gives you a premium.